Good afternoon once again, kings and queens. Happy Sunday to everybody. Welcome. And our financial literacy discussion topic for today is filing taxes. I know everybody's excited. We want to file our taxes, and this one is about personal and business. It's for us to understand the tax laws and how to optimize tax deductions, which is a great tool that can be used to maximize the earned income. So we have two presenters on the call today. They're going to lead the conversation, and that's Mr. Harry Boafo and Ms. Horancia Degrat. These two individuals are the founders and partners at HHP Financial Solutions. They provide a full range of accounting services while giving you the individual attention that your business needs. These two people are very passionate about serving small businesses. So thanks again. On to you guys.
Thank you very much, Folami and ABC, for giving us your platform to share with you guys filing taxes, that's your personal and business taxes. As you rightly mentioned, my name is Harry Boafo, and my partner is Horancia Degrat. So we are founders of HHP Financial Solutions. We provide financial solutions to small businesses and also individuals. Individuals meaning that people own small businesses, and we cannot just separate the business from you. So as you're taking care of their business finances, we also take care of you and make sure that you plan for your financial well-being and also plan for generational wealth, which is something that everybody should be thinking of. So we are here to just, talk you guys through how to file your taxes, personal and also business if you have one. So we'll kick off with the individual side of the taxes, and my partner Horancia will take care of that. So let's go.
Thank you, and I just wanted to add that just to a bit about our bio too. That we coming in with together we have about 15 years of experience, ranging across from audit to federal to financial reporting. So we have experience with big companies. Managing them, their finances, financial reporting, taxes. So I just wanted to add that we have the experience. We are just not coming out fresh with no experience, but we do have a lot of experience in the corporate world that we decided to do our own thing and help small businesses. So we're going to talk about, I'm going to do the individual taxes. So why tax planning? As Folami, yes, I got the name, rightly said, tax planning is very important. A lot of people just file their taxes and wait till the next year. But if you file if tax planning helps you minimize your tax, you make a conscious effort to plan on how to minimize your tax liability and increase your income. For this year, 2020, a lot of, as you know, we have CARES Act, a lot of changes, tax laws has been changed from 2019 through 2020. So things there are little nuances, more new things that we want to talk about and make sure you are aware as you go about filing your taxes for this year.
And to add a little bit to it, for the past 20 years until 2019 or 2017, the tax laws were very stagnant. So people learned it very well and were able to go around it. When Donald Trump became president, he made some changes or drastic changes to the tax code and the tax laws, which resulted to different things being taken out of the individual side and given to small businesses. And also in 2020, when the coronavirus came, they made a couple of changes to the taxes, which is the Secures Act and the CARES Act that we are talking about. So we'll hit on these things as we go on with the presentation.
So in the United States, as we are all aware, we don't have one flat tax rate. Our tax rates are in bracket depending on how much you make. So the more you make, the more you fall into a higher and a different tax rate. It ranges from 10% to the highest of 37%, depending on where you fall and how much you make, what deductions you have, what credits you have. So, next slide. So we are going to talk about the two main things that affect our individual, our taxes as individuals. You get a tax credit or a tax deduction. What's a tax credit? Tax credit basically decreases taxes owed rather than your taxable income. So it reduces, a tax credit reduces the amount of taxes that you're going to pay. It reduces your tax liability. There's two different kinds of tax credits. We have the non-refundable ones and the refundable ones. And not with the non-refundable one, if your tax liability is zero, you don't get a refund. You don't get a refund back. Then one of the main ones are your education credits. So if you have an education credit of $2,000 and your tax liability is zero, you don't get it as a refund. But if we have the refundable tax credit, which is your earned income or your child tax credit, or those of us with kids, we know about the child tax credit. With the child tax credit, if your tax liability is zero, the government gives you a check for whichever, for I think it's up to $2,000. So if you have your tax liability is zero, you get a check of $2,000. You get a refund basically. Now, what about the other one is tax deduction. The tax deduction reduces your taxable income, and that's where most taxpayers have control over. You have more control over your tax deductions. It reduces how much income that you are taxed on. We have three different kinds of tax deductions. You have your standard deduction, which was raised with the tax laws. It was raised, I think, $24,000 for a couple, for married couple, $12,000 for singles. So that's standard. You don't have to keep any records for it. You don't have to do anything. It's standard. It comes automatically to you. Then you have the itemized. Your itemized deduction ranges from, example of that is your mortgage interest, your charitable contribution, or your medical expenses. Those are some of itemized deductions. So if you put together your itemized, how do you decide which one to go with? That would be like, how do you decide which one to go with? If you put together your itemized deductions and it's more than the standard deduction for a single person of $12,000, then you go with your itemized deduction. If it's lower, then you go with your standard deduction.
So the little I'll add to this is that, so for tax credits, we qualify for tax credits, right? It's based on your situation. If you have a kid, you qualify for the child tax credit. If you are in school, you qualify for the LLC or AOTC. For tax deduction, that is what you plan for, right? Because that is your everyday life. So when it comes to tax planning, we always look at the tax deductions. What can I do from the beginning of the year till December, which can help me deduct more when I'm filing my taxes? So that is one thing I want you guys to note as we go through. We'll talk more about the deductions because that is what you can plan for. But when it comes to the credits, you qualify for it based on your situation.
So this is an example of we put together just to show you what the difference is. So if a person has $100,000 salary and has 10,000 in deduction, your taxable income is 90,000, and you fall into the tax rate of 25%. Then your tax bill will come out at 22,000. Now, if you're the same person that makes 100,000 and you have a credit of 10,000, you'll be still taxed at the 25% of 100,000, which means you're only 25,000 now. However, that 10,000 will net against that 25,000, bringing your tax bill down to 15,000. So it all depends on your circumstance, your situation, varies from person to person. There's not a one size fits all, as everybody knows when it comes to taxes. It's very based on an individual. This was just a slide. I think I touched on this to show you the standard deductions, the rates. So if you're single, for 2020 is $12,400. If you're married, it's $24,800. Married filing separate is $12,000 like single, and then head of household is $18,000. So this is the itemized deduction as we spoke about. For medical, you have medical expenses. That's one item that you can use. You can use for your itemized deduction. With medical expenses, you have to your amount that you deduct cannot exceed 10% of your AGI, adjusted gross income. So if your AGI is 100,000, if your AGI is 100,000 and your medical expenses, let's say 50,000, you can only deduct 5,000 because 10% of 100,000 is 10,000. So you cannot deduct 10,000. You deduct the excess of 10%. So that's going to be the 5,000 is what your deduction would be. State taxes, you can deduct up to 10,000 on your federal taxes for state taxes paid. Interest paid, so this is specifically for mortgage interest paid. You can pay up interest on a debt up to 750,000, and that includes home equity line. So if you have a home equity line drawn on your mortgage, and that makes your home mortgage debt exceed 750, you cannot deduct the amount that exceeds 750. So it's your mortgage plus your home equity line if you have that. So this is the meat of our presentation, especially for the individuals. So how do you plan, as we talk about, especially with deductions, how do you plan to make sure that you are getting the maximum benefit when you are filing your taxes? And like we said, you don't wait till when you're filing your taxes to do that. You have to consciously plan for these things throughout the year, not when it's time to file tax, because most of these, by the time you're going to file the taxes, it's too late. So we start with accelerating medical expenses. You can plan in such a way, let's say, and I'm giving an example, maybe you have a non-emergency procedure that has to go, maybe your knee has been bothering for years, and you're also expecting a baby in 1 year. You can plan so that the year that you have your baby, you can also go and do this non-emergency surgery so that you have a lot of medical, because for medical expenses, it has to be at the excess of 10% of your AGI. So you bulk it together so that you can have enough so that you can push you above that 10% threshold, as opposed to doing it in separate years because you can't roll it over either. You cannot roll medical expenses over. You take it in the year that you pay for it. So those are some of the things you can do to plan as a plan when it comes to medical expense. The second one would be converting your residence to rental property. If you have plans to convert your residence to a rental property, especially in a declining market, you can think of maybe getting an appraisal. Now, if your the appraisal comes with your house value lower than what you currently have on the debt for, you can deduct that loss. So if right now the value of your house before the appraisal is like, let's say 500,000. After the appraisal, it's now 450. That 50,000, you can actually deduct it as a business expense. So this is where you are converting it into a rental property and you are registering as a business, not just doing it and not register. It has to be registered as a business. You can always deduct that loss. Charitable contribution. If you go to a church or if you have other organizations and your church is registered as a 501c, you can use that as a tax planning vehicle, where if you can use it as a deduction and it will reduce your taxable income and also benefit. You do good for society. It also benefits somebody. Employee and fringe benefits. So when we talk about these are your FSAs, your HSA. FSA, these benefits are your employer has to offer it. It's one of those things that your employer has to offer it. What is FSA would be your dependable care. So those of us with kids, daycare. The employers usually offer it once a year, and it's usually around the same time when you are signing up for your health insurance. So when you sign up for your FSA, you can have your employer deduct up to 5,000 pre-tax. So it will reduce your taxable income. So if you make 100,000 and your employer deducts 5,000, now you are being taxed on 95,000. You're not being taxed on 100,000. But the catch of FSA is you have to use it all within the same year. You cannot roll it over. So you lose it, use it or lose it. So you have to be mindful when you are signing up for it to make sure, and you have to use it for the purpose that it's assigned. So if it's being assigned for daycare, childcare, you cannot use it for something else. You have to use it for the purpose that it's assigned. The other vehicle is HSA. HSA is a health savings. It's a health savings account, and it goes hand in hand with a high deductible insurance, health insurance. So if you have a high deductible health insurance, a lot of companies would offer you the HSA, and you have to, I think it's about 6,000, I can't remember my numbers, but it's about, you have a maximum of 6,000 that you can save each year pre-tax. Now with HSA, you have it for a lifetime. You can only use it for medical bills, but you have it for a lifetime. You don't lose it. So if you have a high deductible plan, insurance plan, health plan, please think about getting an HSA. Please think about getting an HSA because it will reduce your taxable income. The next thing that you can also use, another vehicle, is education deduction, 529. A lot of states offer 529 to help you contribute and save for college for your children or yourself if you want to do that. The new laws with 529 is now you can use up to 10,000 to pay for private school. With 529, you cannot deduct it on a federal level, but you can deduct it on a state level. So a lot of states gives you the opportunity to deduct the 529 contributions, if not all, part of it on the state level.
So on the 529, the benefit when it comes to the federal level is that any income that you get when you invest the money and you get income, that income is not taxable on the federal level.
Yep.
So for instance, if I have $10,000 and I save it because I want my child to go to college and I put it in the stock market, and 10 years later I pull it out and it's $20,000, that $10,000 profit will be taxed on the federal level. If I put that same 10,000 in a 529 plan, and it turns to be 20,000 for me, and I pull it out for my son's college, they are not going to tax me on that income that I get on that 529. So on the federal level, that is the benefit of the 529. But on the state level, the moment you put that money in there, they allow you to deduct it on the state level.
Yeah, and the other thing, so even if your state doesn't offer, most states, I believe, offer, and if they don't, you can always pick another state and do your contribution there as well. One of the best ways also is retirement planning, 401k, IRA. If your company is offering it, please take advantage of it. You can always go in and take it out to buy a house without any penalty. And with the recent CARES Act, they took away the penalty aspect of it temporarily. So you can still even go in now and take money. I don't know how long that is going to last or how long they're going to keep that for, but you can go in and take money out of your 401k. So that's another avenue. And you have up to 16, 17,000 that you can contribute. And if you contribute 17,000, it reduces your taxable income by 17,000. That's 17,000 that you will not be taxed for at a high tax rate. So please, if you can afford it, put some money into your 401k. Anwar, go ahead.
Okay. Yeah. So the next one is annual gift giving for family. So this specifically, or what we call the gift tax. Every year, everybody is allowed up to about $14,000 for you to gift a family member apart from your spouse. So it can be your son or your daughter. You can gift up to $14,000, and that will be excluded from your income. So for high earners, what some people do is that they do the annual gift giving to reduce the amount of taxes they are going to pay on their taxes. It is the same way if you want to gift property, right? You're allowed, I think the exclusion is up to 500,000. So what people do is that they push income generating property to their children, because I know that I'm already making 120,000. My rental income is also going to bring another 100,000, which will push me to 200,000, and my tax bracket is going to be higher. So my rental property, I push it to my younger kid, and then that income goes to him because he will have a lower tax rate. even though it's also, we call it the annual gift giving, it's also a way to plan for your estate, right? Because once you die, I don't know if everybody knows this, but your family is going to be taxed a certain percentage before they get the property you leave for them. So if you use this annual gift giving, it's a way that you slowly give all your property to your kids without them being taxed on it when you are no more. The second one is exchange like-kind property. And this is very tricky, but I put this here because of Bitcoin, right? Bitcoin currently is taxed more so like a property or like a personal property, right? It's taxed like if you sell a house, the gain you get on a house, that's how Bitcoin is taxed. But if you exchange Bitcoin for a property, you are not going to be taxed on it. So for instance, if I buy a Bitcoin of 50,000 and it grows up to 75,000, and Tesla is allowing you to buy cars with Bitcoin now, right? If I buy that car 75,000 with a Bitcoin, I'm not going to pay any taxes on it. But if I take out that Bitcoin 75,000 in cash, I'm going to pay taxes on that 25,000 that I paid on. So that is why I put this in here, because I know Bitcoin is a big thing now. So people should think about properties that you can rather buy with Bitcoin rather than taking it out cash. So many people are withdrawing the cash and they realize that they owe a lot in taxes because they didn't think about the tax implications.
Or you can even, if you're buying a car from somebody and you have stocks and they understand you, you can, instead of taking out your stocks, selling it and getting a tax on a capital gain of about 15%, you can exchange it for whatever you're buying. Right. That's another way to save on taxes.
And transfer.
Hi, can I make a comment?
Yes, you can.
I think the exchange you're talking about has to be like kind. So it has to be cryptocurrency for cryptocurrency, property of like property. You cannot. I don't think you can buy stuff with Bitcoin and not.
So when you're talking about taxes, right? It's about how it's taxed. It's not about what kind of property it is. So let's say if you have stocks and you want to buy a car from me, and you tell me that you want to exchange the stocks from the car, there's something which is called boot, right? So they'll boot the stocks to zero, and then you wouldn't be charged on the income or the gain on the stocks to transfer it to me. So that is the same way, because if you transfer stocks to me, they are going to charge me on the taxes on top of it. So that is the same concept when it comes to Bitcoin. And I don't know if you realize for the past week or 2 weeks, Bitcoin has been increasing, and that is the mindset. That is why it's been going up, because most companies want to start taking Bitcoin now. And the idea, or what the AICPA said, was that if people are exchanging that property for another property, then that tax is not going to be taxed on it. And let's be very mindful that Bitcoin right now is not really regulated by our tax system. So without you getting cash out of it, you are not being taxed on it. Now they are trying to study and see how they can go about the taxes. So until you take the cash out, there is no way that you're going to be taxed on it. So once you exchange the Bitcoin for a property, there is no way they are going to calculate the gain and you pay the taxes on that gain. So that is the mindset with the exchange of like-kind property that we are talking about.
And as you know, things change every day. Now we can have this conversation next month, and Congress might have now changed the rules and put tax on Bitcoin. So we are talking of as of now. Things change all the time. We know laws, taxes change all the time.
Tommy, is that clear, or you have a follow-up?
No, it's not clear, but I'm a CPA, I'm a tax accountant, so I'm just gonna let you finish your presentation. But thank you for trying to address my my question.
But for the record, we are both CPAs too, and I've been for the past 6 years, and she's been for the past 14 years.
Oh, nice.
Yeah. Okay, so we move on to the business tax planning. So this is for people who have businesses. Income planning or tax for individuals is focused on the short term, right? You can do that only within the year. And that's why I said that it's from January to December. And that is where you do your tax planning. For when it comes to business, it's more of a long-term planning rather than just a short-term one-year planning. So individual versus business. In 2017, when Trump did the tax changes, there were certain things that were kicked out of the individual taxes, which is some of it is unreimbursed employee expenses. Initially, I don't know those of you in the health field or any other field, if you even buy a uniform, you are allowed to deduct that based on the Form 2106. But when the new tax law came, they took those things out. Your tax prep fees, if you do your taxes and you pay the professional, it was deductible up to, I think, 2% of that. That was taken out. Your hobby expenses, investment fees, legal fees, and safe deposit. All these were taken out of the individual taxes. But these activities don't stop, right? So you ask yourself, how do I deduct these activities, even though now they don't allow it? The only way you can do that is through having a business. If you have a business, if you pay for tax prep fees, it's a professional fee you pay, you can deduct it. If you make any expenses on your employees, those are deductible and you can deduct it. So that is why you shift these things from your individual side onto your business side, and that is how you can expense these expenses that we are talking about. This is just to talk about the 3 different types of businesses that we have, or business setups that we have, and just talk about, taxes, how it affects taxes, so that when you're setting up a company, you think about, do I do a partnership, do I do an S Corp, or do I do a C Corp? So with partnership, there is no maximum of partners you can have. You can have up to 1 million partners, they don't really care. For when it comes to S Corps, you can only have up to 100 partners or 100 owners in an S Corp. When it comes to a C Corp, it's unlimited. That is where you float shares and people can buy shares from you. I'll move on straight to how you are taxed. When it comes to partnership, you are not taxed on the entity level. So for instance, we have a partnership, right? So if we make 100,000, we don't pay any taxes on the corporate level. We divide the profit 50-50, and it goes onto our 1040, and we are taxed on our based on our regular tax rate. When you go to S Corp, it's very similar. You don't get taxed on the corporate level. It flows down. That's why they call it a pass-through entity. It passes through to the owners, and then the owners pay taxes on their 1040. When it comes to the C Corp, that is not the case. C Corps are slapped with mostly 21% flat rate. And that is where the double taxation comes in, right? So if you have a C Corp and you make 100,000 profit, you'll be taxed 21% on that. And then when you distribute dividends after paying the taxes, those who receive the dividends will also pay taxes on that dividend. So on the C side, you are double taxed. On the S Corp and partnership or LLC, you are only taxed on the individual tax rate. Even though we are talking about the double tax and single taxes, based on your tax rates, you might end up paying more taxes on a partnership, because if you're in the 37% bracket, and all this profit is flowing onto your personal taxes, you end up paying a higher tax rate. So let's be very mindful when we are doing these things. The main thing I want to highlight on here is that if you have any of these businesses, you are allowed huge or massive expenses that you can deduct, so far as they are eligible. So those are some of the things that we'll look at in the last slide, talking about the business tax planning. Yes, okay. So the first thing we talk about is taxation of net operating losses. So for instance, if I start a business now, and then I make a loss of $100,000, the NOL can be carried back and also can be carried forward. So if I don't have even enough taxes this year to deduct my losses, I can go back to last year and take some of the losses and amend my taxes. If I don't have enough last year, I can carry that losses forward. So let's say if I have a loss of 50,000, I used only 40,000 this year. When I move to next year and I make 200,000, I can take that 10,000 off my taxes, and then my income becomes 190,000. So that net operating losses is something, and even Donald Trump used it for a long time. He had a loss of about, I think, 300 million or so. And that's why he never paid taxes, because he was carrying that net operating loss forward throughout. Deducting of home expenses, home office expenses. This is very tricky when you are an individual, right? Some people say you can take it depending on the square foot that you use in your house. But when you have a business, it's an outright business expense. If you rent the space in your house to yourself as a business, you can outright deduct that as a business expense, because it's a rent that you are renting to the business. Businesses are allowed to rent spaces to use. So that is one. Number three, we talk about depreciation and 179 deduction. And this is very key here if you have a business and you want to buy more assets. When you buy an asset, let's say a car, which shouldn't be more than £6,000, right? When you buy that car, you can say that I'm depreciating for 5 years. The 5 years mean that if I bought the car for 50,000, every year I'm going to take 10,000 of that as an expense. Or you can go the route of 179 deduction, which means that I'm expensing all that 50,000 in this particular year. So if I know that this year I made a lot of money and I bought a car for the business, not in your personal name, for the business, and I want to reduce my taxable income, what I do is that I'll take the 179 deduction and get all that deduction in this current year, so that my income will come down and my tax rate will also come down. If I know that this year I didn't make a lot of money, what I do is that I'll rather depreciate it for 5 years and carry it with me, for the next 5 years. So that is it with depreciation and 179. So having a business allows you to generate more assets and also deduct them when it comes to tax purposes. Qualified retirement plans for self-employed individuals. So when you are self-employed, my partner talked about 401k, right? So 401k is when you are with a company, they tell you that if you pay 3%, you are going to match up to maybe 50% of that. So they are paying that. But if you are self-employed, you ask yourself, how do I do this? Because nobody is matching me. Any money that you pay into an IRA or a qualified plan, that is a deductible expense. So if I'm self-employed and my company is registered and I decided to give my benefit, be a 401k that I pay 19,000 to every year, that is fully deductible on my taxes as expense.
I just want to add in here with that one, it would, for you to be able to do the qualified retirement for yourself, it would have to be only you as an employee. If you have other employees, then you have to offer it to everyone. So that's the key point. If you have employees, you have to offer it as a business to everyone. But if it's just you and a spouse, if it's just you and a spouse, then definitely you can go with the qualified retirement plan for self-employed people.
Also fringe benefits. So when you have a business and you have employees, you can offer fringe benefits to them, which is a way to attract good people to come and work for you. And those things are deductible. You can deduct it. So I think that is all we have. Yeah, so substantiating business expenses. Yeah, this point is very relevant because when you have a business, you don't do things just anyhow. You need to keep record. Good record keeping is very, very essential when you have a business. People will come to you and say, hey, I have a business, I want you to file my taxes for me. And then they'll start to commit into memory, oh, I bought this, I bought this, I bought this. That is not, you cannot substantiate your records with that. You have to be able to keep good records. One of the best way to do that is open a bank account in the name of the business, connect QuickBooks to it, let an accountant handle it for you. Connecting QuickBooks is not just record keeping, because the expenses are not going to the right categories or the right places. So get a bookkeeper or an accountant to be able to, push the expenses to the right places for you, because that's the only way you can substantiate these expenses that we are talking about that you can deduct. Yeah. And I think, that is the end of this presentation. So we'll open up the line for questions. I think we have a couple of questions in the chat, so we'll start with that. And then anybody can unmute themselves and also ask questions.
Thank you, Harry and Horancia. That was very informative. A lot of taxes, I guess, gives people a headache when it comes to taxes. That's why we kind of punt it off to the experts, but I think this is a good. I do have questions, and I'll advise everybody, if you have any question, feel free to raise your hand or tap it in the window, in the chat window, and I'll read it out loud or call you to ask your questions. But I do have some questions of my own to kind of get things started. I think on your second slide, you had mentioned that for personal business planning, that you can convert your residence to, I guess, rental property.
Yeah.
So if you do that to gain some tax benefit, in a year, can you reconvert it back to residence, or once it's gone to rental, it's kind of permanent as a rental property?
No, I just wanted to be, Harry's going to answer that question, but for it to be a tax benefit, I just want to clarify, it has to be in a declining market.
Okay.
So if it's, that's the key. So you just can't decide, oh, you can convert it. It's of course,
you get the benefit.
But you wouldn't get the benefit. It has to be that the value is lower than when you originally bought it. That's the key. So now go ahead.
And also, it has to be in a business, not in your personal name. So you can't just say that, okay, tomorrow I'm renting my house to somebody, so I'm going to take that loss. No, it has to be for a business to get that loss is taken out.
So say in a down market, you convert it to a rental property under your LLC, right? And then maybe the market kind of turn around, right? Things are booming back. You don't have any rent. You don't have any tenant anymore. Can you reconvert it back to residence, or once it goes rental, it's going to be forever known as a rental property?
Oh no, I'm sure once the market turns around, you can reconvert it back to your personal property. But remember, that is meaning that you are transferring it back from the business to yourself. So it will require you to buy it from the business.
Makes
because
sense.
you converted it from yourself to the business. So you have to buy it back from the business. So yes.
Okay. I do have another question before I call on you, Funshaw. So just give me a second, and then after Funshaw, Wale, you go next. But before then, can you touch upon the annual gift given for family planning? You had mentioned that you can give to your kids, your siblings, I think up to $10,000. Is that very similar to how for Christians, how you tithe in church, or those are two separate things?
Those are two separate things.
Okay.
Tithing is to a qualified organization, a 501(c)(3) organization. That is tithing. So because our churches are registered as 501(c)(3) organizations, that is why when you give to them, it's deductible in the charitable contribution part. And remember, when I said that you might have to file gift tax when you do that. So you file a separate called gift tax and you get that exclusion. So that, let's say if you made 100,000 and you give 10,000, then now your income becomes 90,000, and that is where you be filing your tax.
Makes sense. Funshaw, you can unmute yourself and ask a question, please.
Hey guys, thanks so much for today's session. Great conversation. So regarding that last slide you guys just shared, right? You mentioned about you can transfer your property to your child, right? But I've also heard people say transfer it to an LLC just for any liabilities, right? Can you just speak to that regarding the pros and cons of having it go to your kids to minimize taxes, but also people saying, hey, transfer it to an LLC, right? That way you can minimize any liabilities. So
yes,
thanks.
So yeah, very, very well. Both of them are not wrong, right? Transferring it to your kids and transferring it to an LLC. So transferring it to an LLC, one, remember that you form the business and the business is separate from you. The business is separate from your kids. You understand? So the transferring it to your kids, it's more like leaving a legacy for them, or what we call in taxes estate planning. People leave wills, right? And then when they die, their property is transferred to the kids. So when it transferred to the kids, there's something called estate tax. And they have to pay that tax before they get hold of that property. And some states in Texas can go as high, when you add it to the federal one, can go as high as 30%. So imagine your parents leave you a house of 100,000 and you have to come out of pocket 30,000 before you can own that home. You understand? So because of that, you start the annual gift giving. Your parents start giving you that gift before they die. So let's say every year or the first year they put you and then you own half of the building. And the next year they push the other half of the building to you. And that becomes yours even before they die. To go to the LLC, it's more on the income and losses part. If you have a rental property in your name, the deductions are very limited. You understand? Because it becomes more like a passive income. But if you have a rental property in a business, you can deduct every expense that come with it. That is why people advise you to move it into an LLC rather than into the name of your kids. I hope that was clear.
Yeah, thanks.
Wale, you can unmute yourself and ask a question.
And thank you guys for the presentation today. I just had a question on what you mentioned regarding, capital gains. You mentioned when you pay taxes on your stocks when you withdraw, or I always thought like you pay taxes if you sell and you have a profit, right? Can you just talk about that regarding how taxes work on capital gain and capital losses?
Yeah, so when I say you withdraw or take out your stocks, it's the same as selling your stocks. There's no way you can take them out other than to sell them. So let's say if I buy Apple stock and it's $100 today, and it moves to $150, the gains in there is unrealized, so there's no way I'll be taxed on it. But if it goes to $150 and I sell it, the $50 that I gained on it, I'll be taxed on that $50. Regarding if it's short-term or long-term will determine how much I'll be taxed on it. So that is how you are taxed on stocks. It's once you sell it and you get the cash, that is when you're going to be taxed.
So even though you don't withdraw, you still get taxed on it. That's what I was just trying to.
Oh yeah, once you sell it, once you sell it, you'll be taxed on it. Yeah.
All right, perfect. Thank you. Just want to clarify
because
that.
You sell it, the money goes to the broker, so the broker has the funds.
All right, thank you.
All right, we have another question from the chat. This is from Folami Popola. He said, if you transfer to a minor child, let's say 15 or 16 years of age, are they still liable to pay taxes?
It has to be yes, they're still liable to pay taxes.
Okay.
As income, so it's their income. So whatever the income comes out to, they're still liable to pay taxes.
So the benefit
which will come on your taxes. So it will be like because you file them on with you, so it still comes back to you because they're dependent of yours, unless you're having them file a separate tax.
And also, it's not because you are not paying taxes on that, but it's because they will have a lower tax bracket than you to give it to them. So that is the rationale behind it, that I am at a higher tax bracket because my income is higher, around 37%. So I want to pass it on to somebody who has a lower tax bracket. But then you shouldn't use them as a dependent.
Yes, that's the key. You can't use them as a dependent.
Okay. I think on one of your slides, you had mentioned that for partnership type of business, you can have unlimited amount of partners. Is LLC considered one of those partnership? Because it said S Corp and C Corp, there's a cap, right? But LLC.
No, so C Corp has no cap.
Okay.
It's only S Corp that there's a limit of 100 people.
And for LLC, there's no cap as well, right?
Yeah, so LLC, if you're a single member LLC, it's just by yourself. If you're a multi-member LLC, that's if you have multiple people. Technically, when it comes to taxes, they classify you as a partnership. So you file the same returns as a partnership tax return.
Okay.
And then the other thing with S Corp too is you also have to be there a citizen on a resident alien. So you cannot have foreign entities or foreign people as partners on an S Corp.
Gotcha, makes sense. One of the other questions that I have, and I think this came up in the pregame Clubhouse presentation that we had, is knowing that taxes is by the book, right? There are regulations that govern taxes. However, if you have 100 accountants, it's almost as if some of them still come up with different, refunds or taxes that you're owed. So what are the things that one needs to look for when you're picking a CPA to help with taxes? What are the type of questions that you should ask, right? Because as an individual outside the CPA world, you just, maybe a friend of a friend tells you, oh, I've got an uncle that's a CPA, can do your taxes, but there's no real way to know if they're actually good at their job or not. So what are some of the questions that you think would be that one should ask to be able to choose the right CPA for their taxes?
Okay, so I did auditing for almost 6 years, right? and auditing small businesses. And that is one reason why we started this company. The one thing I realized is that most of the CPAs for small businesses, they are not just inputting numbers, they are doing tax planning for them. So to go to a tax preparer or to select a CPA, select somebody who will do tax planning. So probably you came to me in January to do taxes for you, right? Trust me, your 2020 taxes, there's not much I can do about it. But what am I going to plan for you to have good taxes in 2021? That is what you look at. So you tell your situation to that person, and the person tells you that, okay, these are the mistakes you did in 2020. This is what we are going to do 2021 so that you save on taxes. So you can compare the two and say that when I came to this person in 2020, I paid taxes of 10,000. But in 2021, I'm only going to pay taxes of 3,000. That is when you see what a good CPA is. But the mistake most of us do is that we go to somebody and in that year, we want the person to save us taxes. And that is when they start putting in stuff which is illegal in it. And then we start getting letters from the IRS. But a good CPA is somebody who can help you with tax planning and take you to a better place. So you start from maybe you were paying higher taxes, but in the next year or next 2 years, you start that they input all these plannings we are talking about and they reduce your taxes to a better place.
The other thing is also find a CPA who likes to research, not one who just thinks they know everything. That's one of the things we like. Some of the things I don't know, and even between Harry and I, we still have discussions and arguments about laws, tax laws, and we would go and research, and everybody would come and we'll talk it out and decide what's the best approach. So the thing with us is it's not a one size fits all. We look at each person and what is very unique to them. So for me, talk to us if you ask your CP about what is the new, like with the PP, the hot cake right now is PPP. And you ask them about, oh, what's the new PPP laws, how do we deal with it? And they don't say, let me research or give you a good answer and just give you a standard as like a straight answer, like I got it. To me, that's a red flag. It should be, okay, let me research, or the new guidelines are saying this, or they are talking about it. So you always want to have a CPA who is always researching. No matter if you have 50 years of experience, things are changing. Like we talk about Bitcoin. Tomorrow there can be new regulations about Bitcoin. So you always have to be researching and reading and knowing, not just go on, I have 20 years experience, so it's still, things are still the same. No. So for me, that's one of the things we look for. A researching CPA. Ask the questions and don't just let them give you some, excuse my language, BS, but ask them, push and ask them, so force them to research.
And to add something to what she said, for instance, the PPP, right? When it came out, IRS issued a regulation saying that if you receive a PPP, let's say for rent or for payroll, they won't allow you to deduct it on your taxes because it's basically free money that they gave to you and forgave you. But in January, the AICPA took it to Congress and said, no, that is not fair to the businesses. And then Congress is considering allowing the businesses to deduct it. So if you have somebody who doesn't research, he just hears that you cannot deduct it, and that is it.
Yep.
You understand? And he fails to deduct it, and that pushes you to a tax rate that is going to be higher than if you research, you are going to pay. So research, as I said, and tax planning is two big things that your CPA should do for you.
Hi, thanks for this. I have 2 questions. The first question, my name is Shay, by the way. The first question I have is the $14,000 that you gift to your kids annually, is that taxable? Or do the kids pay taxes on that?
No, and that's why the limit is 14,000. If you gift more than 14,000, the excess is taxable to them.
Okay, great, thanks. The second question is, if you hire contractors in a different country and then you make payments to them via tools like Western Union or World Remit, can you claim those payments as expenses on your business?
Yeah, so if the business has, let's say, a branch outside, right, and that branch is registered. So let's say if Coca-Cola has another branch in UK and they are paying people in UK and they have the record showing that the people work for them, it's deductible. But if it's somebody who just works on maybe your house back home and you send the person money, when the thing is that how are you going to substantiate it? You understand? If you get a letter from the IRS. So if there is no way the business can substantiate it, then you cannot deduct it.
Yeah, so I mean, let me give you a better example. These are some people building a mobile app for me, and I'm making payments to them. I send it via like different international money transfer mechanisms, and so I have records showing those transfers.
Yeah, so you can deduct that on your business taxes. Since the business is here and the apps are created here, these are costs that goes with it.
Right, the apps are created, I guess they're here, but the developers are in a different country. I guess that was the main part. And the reason why I'm asking that question is because I know for if you were to hire a developer in the United States, once you're done with working with them, you give them a 1099, right? But then if they're not in the United States, there's really no way you can give them a 1099.
Yeah. So what I've seen some people do is that, or even when you do investments, right? When somebody from outside comes to do investments here, the gain, they withhold part of it for taxes, right? So even though they are not resident, they don't have a social security, they'll tell them, hey, come and file your taxes to get the withholdings. If not, they push that money to the IRS as taxes that those people paid. Because what will happen is that if you put those deductions in as expenses, IRS will come and ask you, where are the 1099s? If you send the 1099s with Social Security 00 or dash, they will come after you for the taxes. You understand? So if it's less than $600, you can push it in. But if it's more than $600, then yeah, you need to withhold something for the IRS when they come after you.
Okay, thanks.
All right, Wale, you can ask a question.
Yes, thank you, Ayo. Question I have a friend that's starting a business. Now they have a few questions on taxes. Do you guys do consultation, and how do you guys charge? Like, what are your fees for consultations?
Yeah, so we do consultation, and the first 30 minutes is free because that's where we do client assessment. We'll listen to you and what you want to do. So that one is a free 30-minute consultation. And after that, based on what you want to do, will depend on the tax, on how much we're going to charge you. If it's taxes, the charges is different from if it's just consulting with us. And it starts from, consulting starts from about $65 per hour to $125 per hour based on what you are consulting to us on.
Also, how does somebody contact you?
Yes, so we have to share it. I'll share a slide with our details on there, and then I'll leave that on there.
Okay, so while you're sharing the slide with your contact information, Wally, do you have any follow-up questions, or that's it?
No, that was it. Thank you.
Okay. So I do have one more question from my end. If I use a tax preparer or CPA to file taxes, and then I get in trouble with the IRS, I know that I get in trouble, but does the preparer also get in trouble, or do they normally just kind of wash their hands once I sign the taxes and then it's sent to the IRS?
Yeah, so and it's good you said that you are in charge of your numbers on your taxes is your responsibility, right? But we have certain fines here, $500 here, $500 there for preparers when they make certain mistakes. But if it's a consistent thing, like if you have 10 people going to the same CPA and he made the same error, or he tried to reduce some taxes or take some forms off, that person can be jailed. So if it's a consistent thing that a person is doing, the person can be jailed. But if it's an honest error, honest mistake that he made just based on you, you might just want him to amend for you for free without paying him, but he wouldn't really get in trouble. But if he's basically doing that and making money from people, that he's going to go to jail. So
technically, before you sign your name on any prepared tax, you need to fully understand what's in it.
Make sure you understand the numbers. So that's one thing we do. We prepare a draft, we send a draft to you, we run through the numbers with you and tell you this number, this is how we came by it. This is why we are putting this number here, so that you understand everything on here and you say, I agree. So we don't just send you one sheet of paper with a line saying sign and then, let's go. No, we want you to understand everything that comes behind every number before we send the taxes.
Yeah, the reason I ask is I know that most of us, we rarely read the terms and conditions of, anything that we do. We just scroll to the bottom and click accept. And when the tax preparer also sends us something, we're like, yeah, I'm getting a refund, so it's good enough for me. Say, yep, thumbs up, file it. But like you said, it's good to make sure that, all the numbers, it's something that you understand, because you have to bear the responsibility if something is wrong on it.
And I think it goes back to your earlier question. How do you get a good, know this a good CPA? You should have a CPA who's able to walk you through the numbers there, and not just give you like, hey, you got a refund of 2,000, yay.
Exactly.
Because it also goes to financial literacy. You have to understand, it helps you understand your numbers, your income, and what is going on. So I think that's another good thing. Like, you have to be able to sit, your CPA should be able to sit with you and walk you through what numbers is being inputted. And you understand it too. Help you understand it, yeah.
Awesome. Thank you so much. This is very informative. There are no more questions in the chat, and I don't have any more questions. So thank you again, and I'll pass it on to Dorian to just close us out.
All right, thank you guys. Thanks. That was a great information. I really enjoyed it. Before we end, I'd like to end our last section, common sense finance. I'm sure you guys are familiar with that. And there's a lot of gems. You guys already dropped a lot of gems already, but I would like for you guys to leave us with each some common sense finance tip for us to think about.
So I don't want it to be too deep, like when it comes to this, as you said, common sense.
Right.
The main thing I'll leave is about taking advantage of your company benefits and also 401k. If your company is giving you 401k, it's free money that somebody's giving you. Few stocks will do 50 cents on a dollar, right? So if they're giving you 50 cents on a dollar, I'll say go ahead and take it because it's for your future. So go ahead and do it. Also, when it comes to the FSA and HSA that we talked about, those are ways that you can reduce your taxable income. So make sure you go through the benefits your company have, and then make sure that you're taking full advantage of it, because it's part of the reason they hired you and it's part of your compensation. So let's make sure that we are taking full advantage of that to help us plan for our future and also reduce our taxes. So that's what I'll say.
I think what I was saying is kind of in the same line. I always tell people, and people look at me like, I always say, plan for your retirement before you plan for your children's education. That's and people are like, what do you mean by that? What I mean is, your retirement, you have less time to work hard and save money for your retirement, as opposed to your children have a lifetime to work, go to school, get loans, work and pay off those loans. I'm not saying let's not pay our save anything for our children, but I'm saying maximize your retirement first before you prioritize your retirement. Because if you use your retirement to pay for your children's school fees, you'll be at 60, 70 still trying to work, while they're at 24 active and having no loans, and they have 40 years of their life, 40 to 50 years of their working lives ahead of them. So not saying don't save for your children, but prioritize your retirement over your children first, and then your children's education, college funds. That's my general.
Yeah, thank you. That was great, actually. They both make a lot of sense. And like we said, it's common sense, right? But they say common sense not so common. So that's why I like this session a lot, because things we don't think about, but when you think about it, you're like, oh, wow, that's so true. So thank you so much, both of you guys. And just want to say thanks to everyone for joining us today. Like AJ said earlier, for sharing your Sunday with us. So we really, really appreciate it. Once again, this is African Business Club. Our goal is to normalize financial literacy, promote collaboration and sharing of information among Africans. I just want to say, I don't usually say this a lot, but this is, you all know this is a free platform for information, and I learn a lot myself. I go back every time to watch the videos. When the videos come out, the videos usually come out on Tuesdays or Wednesdays. And all we need from everyone is just share this information, share our YouTube page, share the flyer with your friends and family. Let them learn. Don't be selfish about it. Don't let it alone. I know every Sunday when we have this, I see all my sisters here and my friends. So same thing, invite your family members. Let them join, let them learn. So that's really what we ask from everyone. And so we can empower our community, because this is what this really is about. It's for the community, financial literacy, for us to be ahead. And we're still playing catch up, let's be honest, but this is what we're trying to do in this platform, for us to catch up. And some of us are advanced, but as a whole community, we are playing catch up. So please share this information with your friends, share the flyers. Every Sunday, every other Sunday, 5 p.m. we'll be here. And on Tuesday, we have Talk to Us Tuesday. Is similar to the Zoom. Zoom is 7 p.m. this Tuesday coming up on the 23rd. We actually have our speakers. Harry, I know Harry, I already spoke to him, will be joining us on Tuesday. It's just for us to go deeper, and I know there's a lot of questions that we still want to ask or talk to Harry about, especially with the stimulus package, everything going on. Harry will be with us on Tuesday. We're so honored to have him again. He's gonna be able to answer more questions and just go into further discussion. So please join us on Tuesday. We'll share the information. We'll send it out on Discord and on WhatsApp. And that reminds me, if you've not joined us on Discord, the Discord app is just for us to share information. There's a lot of knowledge, information shared there every day on Discord app. So join us. The link is right there on the chat. So just click it and you can join us on Discord. We learn a lot from there every day. And the YouTube, like I said, we'll post this video on YouTube by Wednesday. And so just watch it again. You will learn a lot, because I learned a lot when I watch this YouTube videos again. And and that's it. Before we end, AJ is gonna post the poll for you guys. Just a quick poll, just to take the poll and answer. It's just for us to get some feedback and see how we can improve or what we can do better to bring more value to everyone. But lastly, I'd like to remind everyone, I love to say this, we are all kings and queens. So let's respect one another, let's love one another, let's look out for one another, and let's keep winning. With that said, thanks everyone. Once again, this African Business Club. Take the poll, and we'll see you guys on Tuesday. Peace and love. Thank you, guys.
All right, thank you guys. Take care.
Thank you.